please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Decline in oil as well, a bit from the high point, and we have seen marketing margins also perhaps back to not the best, but at least in the positive. MK Surana, CMD of HPCL, is with us now. Mr. Surana, good morning. So right now, how's the business looking? You have, of course, the refining and marketing, both parts. Tell us, how is it shaping?
So let's start from crude. Crude is more stable than what it used to be 1 year back, basically because of strong compliances from OPEC side to keep it not going much below. At the same time, strong supplies from US supplies also gone, I think, almost at around 10.8 million barrels a day. So right now, crude prices are stable. We expect it to be stable at least through March because the Asian refinery shutdown seasons are right now on, which checks the demand under control. In the second quarter, probably the demand will improve, the Asian refineries will be back, Ramadan season will be there, driving season will be there. Then we can see some strength on the crude side. Okay. As far as cracks are concerned, right now because of the refinery shutdown period, the cracks are stronger. LPG prices are lower and likely to be weaker because of the more supplies from US. But gasoline and gas oil cracks should be good. Okay. That's my feel on this.
Okay. Good morning, Mr. Surana. Thank you for joining. When you say cracks are good, can you give us an idea as to what they are at? And your own margins, sir, can we be reasonably sure that they will be higher this quarter, and how much better than last quarter?
So as far as gasoline is concerned, it is in the range of, let's say, $11 to $12 or $13 to $14 maybe, and gas oil in $14 to $16 because the gas oil, the inventory base is low and demand is good. As far as gasoline is concerned, right now because the refineries are shut down, so the demand will be there. And then the driving seasons, etc., will start in Q2 season. So the gasoline cracks should be in the range of 13 to 14, and gas oil cracks in the range of 14 to 16. Naphtha cracks are slightly softer because of the weaker LPG, because this goes to crackers, and there are some of the crackers are also under shutdown. So naphtha cracks are lower. Okay. As far as the oil marketing companies are concerned, right now because of the crude prices have come off from the higher side, the cracks are good. So the business at our side, especially the companies who got a refinery and marketing portfolio, should be good, and we expect to post the healthy margins in Q4.
So when you say healthy margins, what would you be looking at? Because the trend for retail fuel margins has been on the upside for a while. What kind of an average are we looking at going ahead?
I won't be willing to probably give a specific numbers to the marketing margins, etc. But there are two components. The GRMs are good right now, as I mentioned, and Q4 should be, I expect to be strong GRMs. Marketing margins, we are able to recover the cost and the expenses which we have. So there are no under recoveries to that extent, and we should be able to do good.
Okay. How are volumes doing, Mr. Surana?
Volumes are good. This year, especially 17-18, the overall demand growth had been quite good. MS had been almost from, let's say, April to February, almost 10.5% growth. Diesel is around 8% growth. LPG is around 8% growth. So overall, all products, if we put together, it is almost in the range of 6.5%. Even the same thing is backed by the demand in the auto sector, two-wheeler sectors. Almost the total product consumption in the country has crossed 200 million metric ton. So growth has been quite good, and it is sustaining. In fact, the MS has put up almost 2 million ton every month additional. So it's quite strong, and the momentum is continuing as well.
Mrs. Surana, two-part question on this ONGC issue. Do you expect integration to be smooth? And you know, the relationship between two companies, does it remain at arm's length, or does HPCL get a bit of a preference in terms of the crude oil sourcing from ONGC?
No, we are still working out the synergies, but as far as crude oil is concerned, it remains at arm's length, because in country, as per the contracting arrangements which we have, what we call production sharing contracts, in that the government has got a right to allocate the crudes. So even today also, if a company has got a crude oil wells and the also processing arm, they do not automatically have got the right of the crude for themselves.
Okay.
Except for the newer concessions or newer rounds which are coming, there are certain more liberalization has been done, especially like gas in the high pressure, high temperature zones, or in the small field rounds, where there is a freedom to supply the crude at to anybody and at the price which is market driven.
Yes, sir.
So as far as ONGC HPCL is concerned, the present supply fields, it is arm length.
Okay. So there's even more interest
And
in
the other synergies, we are working it out.
Okay, sorry. We were even more interested on the HPCL MRPL situation. Can you give us some update on what are the acquisition plans, if any, and if it is an acquisition, is it cash, is it share?
No, we are working out the overall synergies between the two companies because there are multiple points where we can create synergies, and MRPL is one of the items in that, and we will be discussing that. So once more concrete thoughts are available and we have worked out the thing, then we'll definitely let you know. But otherwise, right now it will be slightly premature to define the contours.
All right.